Let's go over why buying a house is actually bad for you. Buying a house is a big financial decision that can give you peace of mind and a wonderful place to live, but it's not an investment. It's common for people to think of their houses as an investment, but I'm going to show you why it's more of a deadly cost and loss of opportunity. A single family house that you live in is not an investment. Now guys, I'm not saying you should avoid home ownership, but if you're leaning towards buying a house because you think you're making a smart move in the world of investing, please think twice. The idea that your primary residence can be an investment comes from the fact that, well, historically, real estate values rise. How many of you know someone like your parents or grandparents who talk about the days real estate was so cheap back in their time and now it's many times that price? Let's take a look at why it's not an investment. Number one, because your house appreciates, it doesn't make it an investment. Yes, over the long run, average house values appreciate slightly more than inflation. If we assume that a house's value increased only at the rate of inflation, a property purchased in 1960 for $100,000 would be somewhat worth $700,000 today, more or less. I like easy math. So the real reason your grandfather's house appreciated so much past 60 years was simply due to inflation. The government is printing more money and more government money, and paper money is losing its value. That's all. All right, I'm not saying that real estate values cannot appreciate dramatically. They can, all right? They have and they do. But that sort of appreciation happens more in specific zones and specific desirable real estate markets. Okay? But guess what? It doesn't matter whether or not your house's value outpaces inflation. There are other reasons your house isn't an investment, okay? A true investment requires more than just property appreciation. Number two, your house has an overriding purpose. Probably the reason why where you live is not an investment is because the main purpose is that it's providing your shelter, a place to eat and sleep. One of the basic principles that makes an investment is your ability to control the timing of your ownership. Think of stocks, bonds, mutual funds, and even rental real estate. You can buy it and sell it at times and situations where you're going to maximize your returns. But since your house is your personal residence, you're going to have little control over the purchase and sale from an investment point of view. You'll purchase the house when it's needed for shelter purposes and sell it only when it's no longer needed and no longer serves that purpose. Then it's time to move on. That lack of control over the timing of buying and selling a house had a major negative effect on houses as investments during the financial meltdown. Many people bought houses at the top of the market because that was the time they needed a house for their families. But still, others were stuck having to sell after the market collapsed, and due to a negative change in their own personal financial situations, they were forced to sell their house very cheap. All right, so that forced them to buy high and sell low. All right, that's not unusual when it comes to residences and largely disqualifies a house as an investment. Number three, a house is not an investment if you never plan to sell it. Yes, houses generally increase in value, but you're limited because the most efficient way to gain the profits is to sell it, which is disruptive to your life because it means you have to move. More importantly, when you do sell, you will most likely have to use the equity from the sale to purchase the next house, meaning you will be moving from one residence to another. This means that in a real way, your home equity is trapped equity. It's dead cash. You sat on your cash and froze it instead of having your money work for you. According to Robert Kiyosaki, that's the poor and middle class mentality. The only time that house does not fall into this trapped equity situation is if you plan to sell the house to either trade down to a less expensive house or to move to a rental situation. In that way, you will sell the property and cash out on the equity. Number four, the cost of owning a home is far too high for it to be an investment. Normally, when you invest in a rental property the way I do, the rent covers all the expenses and leaves you some cash flow. All right, but a house only takes money out of your pocket. Not only do you have to make monthly mortgage payments, you also have to pay real estate taxes, homeowners insurance, sometimes private mortgage insurance, and utilities, right? Gas, water, electricity, and internet. You also have to maintain the property, which means providing a regular series of repairs and maintenance as necessary. So these expenses are called carrying costs, all right? The costs of carrying the investment Even more costly than repairs are all the fancy ideas you're going to get on remodeling your house and purchasing top dollar furniture because it's your house and you'd like it to be a cozy investment. Over the course of several years or decades, each of these expenses can cost tens of thousands of dollars. True investments don't require this kind of ongoing outflow of cash. But hey, you will rationalize those expenses in your head and say, hey, it's my house, based on the fact that this house is providing you shelter. But back to my original point, a house is shelter, not really an investment. Jim Rohn says it best. He says, if your outgo exceeds your income, then your upkeep is your downfall. Number five. The carrying cost of owning a house can be really expensive if you add it all up. Say, for example, if you purchase a house for $100,000 and 10 years later you sell it for $200,000, good investment? Only if you don't look at the numbers too closely. If the house costs you $500 per month for principal, interest, tax, insurance, you call it a PT bundle, plus $150 per month for utilities, you will have spent $7,800 per year, or $78,000 for the decade that you lived in that house. If you spent another $1,500 per year on routine repairs and maintenance, you'll spend another $15,000. And if you did some of the most major repairs, like replacing the roof, flooring, remodeling the kitchen and bathrooms, you probably easily sunk another $25,000 during the decade. So that's a total of $118,000 over a 10-year period. To get $100,000 gain on sale, sure, it feels nice to exit with $100,000 extra than you paid for it, but when we get down to the nitty-gritty, the math doesn't support the idea of the house being a winning investment. Again, you didn't make anything. We haven't even accounted for transaction expenses like 3% or 6% agency fees, inflation, or for the fact that the value of the house may not even rise dramatically over the next 10 years. Number 6, your house is not generating cash flow. It's bad enough owning a house, aka a liability that only requires carrying costs, but it gets even worse, guys. The house you're using generates no cash flow. And cash flow is by far my favorite wealth generator in real estate. When you buy an investment, you usually expect to have some sort of cash flow on that asset, guys, while you're waiting for it to appreciate, right? When I decide to put money in an investment, I ask myself, how much are my cash on cash returns? How soon can it be flowing cash back to me, into my bank account? If you seriously would like to live in your property, it's best you do house hacking. In fact, that's the best strategy to use if the house is a small multifamily structure like a duplex, triplex, or fourplex. You could live in one property and rent the rest of the additional units and that provide you rental income. So you practically live for free. But if it is a single family house, there's no cash flow. Number 7, appreciation is a key wealth generator, but investors don't rely on it as it's not guaranteed. So let's go back to the number 1 reason why so many people consider their house to be an investment. The whole idea came from the rises and the falls on the future value of property. During the times when the value of the houses increase, people commonly think of their house as investments. But during the financial meltdowns, and particularly in certain markets, not only did the values not increase, but most fell. Some fell crazy amounts, man. For people in that situation, not only was their house not an investment, but it had become a major liability, and too many people sell off quick and accept their losses because they were living in their house. So many people out there have the idea of real estate investing wrong, guys. They go ahead and buy the wrong type of property using the wrong mindset, the wrong strategy, the wrong way, and the wrong time, and with the wrong advice. And when the market drops, they panic. That doesn't sound much like an investment at all. And it's probably best you think of it as a place to live, okay? Don't think of it as an investment. So where am I going with all this? Basically, here. Don't think of your house as an investment. Make sure that you continue to put money into true investments, like real estate that produces rental income. More importantly, it must cash flow positive. The type of properties I buy are found in the 3% of the real estate market. That's right, 97% of the properties are rubbish, all right? And are sold top of the dollar. We're just about the right market value, okay? They don't cash flow positive. You don't make money from them. The properties I shop for, I make sure about I buy it 20 to 30% below market value, and I do a couple quick calculations and assumptions, make some tests to make sure it cash flows. If it doesn't, either the price has to change, the terms in the bank has to change, or the property has to change. All right? It's important not to be emotionally attached to the property. That's the problem with most people. They're looking at it from a collector's mindset. They're investing with their heart. So let's wrap it up. We are near the end of the video. Thank you for watching. It's Sanan Sanani, and if you'd like to know more about real estate investing, jump on my free 90-minute virtual class where I reveal the 3 secrets that I implemented that made me go from owning 0 properties to a property millionaire in less than 5 years. I'll put the link in the description below. See ya. Thanks for watching. I appreciate your time, and I hope my video today was valuable for you. Till next time, don't forget to subscribe.